start the recording right now. Welcome, guys. We are working on chapter 7 today. And again, Angel's good at this, but when you have questions, you just stop me and let me know what your questions are, because this is only as good as you contribute with me and let me know how I can assist you. I'm going to stop my video, but you can hear me and you can see the screen, correct?
Yep, I can.
Great. Okay, guys, so this week we are pretty much going to focus our time on assets. Long-term assets at that. Now, long-term assets can be physical assets where there's a physical substance to it, or there are assets that are called intangible assets. These intangible assets do not have a physical presence per se, but they still can be extremely valuable. Tangible physical assets, we've talked about a lot of these: land, buildings, equipment, natural resources, whereas our intangible assets are usually derived from contracts. They would include patents, trademarks, copyrights, franchises, and goodwill. And we're going to talk about all these today. Here you see, hey Jim, can you get me my cup? Here we see a balance sheet of Darden restaurants. You know, some of these you'll recognize: Olive Garden, Red Lobster, the Capitol Grill. I don't know some of these others. Oh, Seasons 52, I do know of that one. But anyway, here it shows the PP&E, but it also shows the intangibles. And you can see the intangibles are fairly significant in assets. Even though you don't see them, they are significant on the balance sheet. So, how are assets acquired? Generally, they are acquired because they are purchased. So assets are usually determined or recorded on the books at the original cost of the asset, in addition to all the expenditures necessary to get it ready for its use. Thank you, honey. For example, land. Land includes the cost of the land and all of the costs that are necessary to get the land ready for its intended use. So, for example, when you purchase land and then you are paying any real estate commissions, or if you have to pay back property taxes that others maybe have not paid in order to purchase that land, or any clearing or filling or leveling of the land, all of these costs will get included with the purchase price of the land. So as you see here, the purchase price of the land, along with commissions and back property taxes, removing an existing building, title insurance. Of course, we would subtract any monies we receive from those salvage materials on the building, cost of leveling the land. All of this gets included in the purchase price of the land. So here we've got one here, guys, our first of the day. So we've got an Italian pizza company purchased land as a factory site for $90,000. Prior to construction of the new building, the land had to be cleared of trees and brush. Construction costs incurred during the first year are listed below. Determine the amount that the company should record in the land and the new building accounts. I'm going to give you a minute, and I want you to attempt this, okay? So what do you guys have for the amount that would be recorded in the land? And what would you have the amount that would be recorded in the new building account? Any ideas?
For the land portion, I'm gonna guess that the land clearing cost and then the investigation of land and then the building construction. So 407,500. I'm thinking.
So Angel, thank you for taking a step and doing that. So if we break down the land separate from the building, we're going to see the purchase price of the land along with the clearing cost minus the firewood sale plus the legal fees. That amount will be attributed to the land. For the building, we'll take the architect fees along with the building costs. The $3,000 of current property taxes will be expensed on the income statement in the current year. It's only when we pay back property taxes that before we purchase an asset that we would capitalize those assets. Any questions on this at all, guys?
I just want to make sure. So I know that when I was reading that it says is the building part of it the same as like the furniture, equipment, and machine operation? Is that different from this example?
It would be the same concept, but furniture would be categorized separately from buildings, from land, from equipment. You know, we categorize all the assets into their specific category. Okay.
Yeah, it just looks different. Like it looks, because I remember that it said that you do it, the land is separate from, like, I want to call it amenities, I would say, or when you remodel the property or the building and like make improvements to it. So I don't remember seeing anything that separated it from the building. That's why I kind of got confused.
So the reason we always separate land is because you can never depreciate land. Every other asset you can depreciate, but you can't depreciate land because it never gets used up per se, unless you're in Ukraine and they're going to nuke it, and then it becomes kind of worthless. That's a little side note, but generally land will never be used up. Now, there are various assets. Land improvements are amounts spent to improve land, such as parking lots and sidewalks, landscaping, lighting systems, driveways, fences, and sprinklers. Buildings can consist of all kinds of buildings: administrative offices, retail stores, manufacturing facilities, warehouses. They're all buildings. They're all just different types. Now, to get a building ready for use, there might be real estate commissions, inspection and remodeling costs. All those items to get the building ready for use would be capitalized. But those recurring costs that happen year after year would be expensed on the income statement. Utilities, insurance, property taxes, those are common annual costs. Okay. Now, equipment. Machinery that's used in manufacturing, or it can be office equipment, computers, vehicles, furniture, and fixtures. This is another category of an asset. To include the cost of the equipment, we would add to that if sales tax is needed, any shipping or assembly, any cost that will get that asset ready for its intended use. But again, those costs that will occur each year get expensed on the income statement. So here, for equipment, we would take the purchase price of the equipment, add to it sales tax, transportation, shipping, insurance, installation, to get a total cost of the equipment here to be $91,000. Oftentimes, when individuals or companies purchase equipment or any purchases, usually it's in a basket. They purchase more than one asset at a time. When this happens, the way we determine what each asset is, what we're going to show as its cost basis, is by taking the various assets and coming up with an estimated value of the assets to the total. So in this case, we are going to purchase the land, the building, and the equipment for $900,000. We separately need to look at what is the value of the land, what is the value of the equipment, and the fair value of the building. You come up with the individual amounts to the total, and we come up with a ratio. If the land is 20% of the total, then 20% of that 900,000 will be the amount we record for the land, 70% for the building, and 10% for the equipment. We allocate the basket, the group of assets, accordingly to their full values, or all the assets values, and then take that percent by what we're purchasing all the goods for. So here is an example. Red Rock Bakery purchases land, building, and equipment for a single purchase price of $600,000. The estimated fair values of the land, building, and equipment are $175,000, $455,000, and $70,000 respectively, for a total estimated fair value of $700,000. Determine the amounts Red Rock should record in the separate accounts for the land, the building, and the equipment. Here you see the estimated fair values of the land is $175,000, the building is $455,000, and the equipment is $70,000, which totals $700,000. If you take the land proportion to the total of $700,000, you get the allocation percentage of 25%. So 25% of the purchase price is going to be allocated to the land, 65% to the building, and 10% will go to equipment. Okay? That all right? Make sense? So that way, 25% of 600,000, 150,000 goes to the land, 65% goes to the building, and 10% goes for equipment. A company makes a basket purchase of land, buildings, and equipment with estimated fair values of $70,000, $150,000, and $30,000 respectively. The purchase price is $210,000. How much should be recorded to the land account? I want you to put your answer in the chat box. What do you think? $58,800. So what we would do in this case is if the purchase price for all is 210, then what we would do is allocate the percentage to the land account. So the land would be 70,000 to the whole purchase. 28% would be allocated to the land. How many of you guys got that? Make sense?
It makes sense.
Now, natural resources. Natural resources such as oil, natural gas, timber, and salt are a little different from other assets because these types of assets get used up. And what we call for being used up is called depleted. There's depletion associated with these natural resources, which are an asset. For natural resources, we will record these at cost plus all other costs necessary to get the natural resources ready for their intended use. Again, all physical assets, land, improvements, buildings, equipment, and natural resources are recorded at cost plus all costs necessary to get the asset ready for its intended use. Now we have the intangible assets. So these lack physical substance and are usually based on a legal contract. They can be developed internally. More often, they are purchased. So what are these intangibles? A patent. A patent is an exclusive right to manufacture a product or to use a process. Oftentimes, when I think of a patent, I think of drugs. The famous Viagra that changed the world of many old men was a patented drug. It allows the person that holds the patent to have an exclusive right to manufacture that product. It's granted for 20 years. When it gets purchased, they capitalize the purchase price plus all legal and filing fees. When patents are developed internally, the only thing that can be capitalized are the legal and filing fees. All the research and development costs get expensed. Guys, have you guys ever had a drug that's real costly And then after the patent has been fulfilled, all of a sudden anyone can manufacture the drugs and they're cheap. That's why. Patent allows whoever purchased this asset to kind of be able to have a little higher price so it can pay back some of those costs of developing it. Copyrights. A copyright is the exclusive right to protect a certain creator of published work. So the copyright is given to the person who created the work, the life of them, and then in addition, 70 more years. It allows the holder to pursue legal action against anyone who attempts to infringe upon the copyright. Basically, the accounting is going to be similar to what we do with patents. Trademarks, words, slogans, or symbols that specifically identify a company, a product, or a service. This can be renewed indefinitely for 10-year increments. Again, trademarks, you're going to capitalize the legal fees, the registration, and the design fees, but advertising gets expensed as it gets incurred. Franchises are the exclusive right to use, a franchise is the exclusive right to use the franchisor's name and to sell its products within a specified geographical area. Usually the initial fee gets capitalized as an intangible asset, but then those fees that happen throughout the years, periodic payments, those get expensed each year. Many of you are familiar with this, and the prices are just different everywhere. I mean, McDonald's franchise fees are very, very expensive. Quiznos, I remember when Quiznos was big a couple of years ago, I had several clients that purchased Quiznos franchises. I think they would purchase them for $25,000. I don't know where Quiznos is anymore. I thought they had good sandwiches. Now, goodwill is an intangible. This only occurs when one company acquires another company. And the way you figure out the amount allocated to goodwill is you take the purchase price minus all the fair value of the net assets acquired, and anything above and beyond that will be categorized as goodwill. Now, what is a net asset? It's the asset you're acquiring minus any liabilities you're assuming for the asset. Again, goodwill is that excess amount. So here, if one company acquires another for $36 million and they acquire identifiable assets of 50 and the liabilities associated with them of 24, means the net asset here is the difference. The 50 minus the liabilities or the net assets would be 26. So 36 million, the purchase price, minus the net assets they are taking, would mean that excess amount, or 10 million, would be classified as goodwill. One second here, guys, excuse me. Okay, so as we know about all the various types of intangible assets, we're dealing with patents, copyrights, franchises, trademarks, and goodwill. So Satellite Systems modified its Z2 satellite to incorporate a new communication device. the company made the following expenditures. So we've seen the basic research to develop the technology, the engineering design, the development of a prototype, the testing and modification of the prototype, legal fees for patent application, legal fees for successful defense of the new patent. We've got a total here of $6,178,000. During your year-end review of the accounts related to intangibles, we discovered that the company has capitalized all the above as cost of the patent. Management says that the device represents an improvement of the existing communication system of the satellite and therefore should be capitalized. But you, knowing better, are going to look and see which of these should be capitalized to the patent account and which of these costs should be reported as research and development expense on the income statement. So we know the only items to capitalize would be legal fees for the application and legal fees for a successful defense. So out of this $6,178,000, the only fees we're going to capitalize or treat as an asset would be $118,000. The rest will be expensed on the income statement in the period in which they were incurred. The basic research to develop the technology, this is all research. Engineering design work, the development of the prototype, and the testing are all put into research and development expenses. How do you know what to capitalize and what to expense? When you purchase intangible assets, they are normally capitalized. But when you develop them internally, most of the items are expensed except for filing fees and legal fees. So guys, which of the following is an exclusive right to manufacture a product or to use a process? Is it a patent? Okay, so we purchased the asset. Now we're going to look at what happens after we've acquired the asset and what do we do with various costs. We will have various costs such as repairs and maintenance, additions, improvements, and litigation costs. We will either expense these costs or we'll capitalize these costs, depending on the scenario of, do they just benefit the current period? If they just benefit the current period, we'll expense them. But if they benefit future periods, we'll capitalize those costs. So here we've got any repairs and maintenance that benefit the current period, such as oil changes, tune-ups, we're going to expense. But let's say we have a repair or a maintenance that's not just going to help now, but it's going to increase either the life of this equipment or provide some better benefits. And it's going to benefit not just this current period, but future periods. If that's the case, we'll capitalize it. We'll treat it as an asset. If we add a new component that's going to benefit future periods, we'll also capitalize it. If we replace a major component that's going to benefit future periods, we capitalize it. And when we have legal fees to defend the right to the asset, we will always capitalize that if the defense is successful. If it's not successful, then we're going to expense it because it looks like we didn't win. Therefore, whatever we think our rights are to this asset are no longer. Does that make sense? Remember, we treat it as an asset, or we record it as an asset if these costs benefit future periods. But we treat it as an expense if it will only benefit the current period. Okay? Okay. Which of the following costs would be expensed? What do you guys think? Adding a refrigeration unit to a delivery truck? No, that would benefit future periods.
Yeah.
Adding a new suspension system to delivery truck, that would allow for heavier loads? No, that would be capitalized. Adding a new transmission to a delivery truck, that would be capitalized. Performing a tune-up on a delivery truck, that would be expensed. Now, cost allocation is really about depreciation. When you look at the dictionary term of depreciation, it means a decrease in the value of an asset. That's not what we intend to do and what it means to us as accountants. In terms of the accounting concept of depreciation, it's truly an allocation or allocating the asset's cost to be expensed over the period of time that asset will be placed in service. So if we have an asset we purchased for $5,000 and it's going to benefit us for 4 years, we depreciate or allocate that cost over the asset's useful life. Since it's going to benefit us for 4 years, we're going to allocate it for 4 years. Depreciation is just an allocation of a portion of the cost of the asset to be expensed over each period. So we have a local Starbucks and they paid $1,200 for a piece of equipment. And it has a useful life of 4 years. To record the depreciation, we're going to take that $1,200 divided by 4 years, and we're going to take $300 of depreciation each year. So our depreciation expense gets debited, and our contra account, accumulated depreciation, is credited. So that would be the journal entry, and the way it would show on the balance sheet is we would show the cost of the asset less the accumulated depreciation that's been taken to show the book value now, or the adjusted book value of the asset after year 1 is $900. If you think about it, after year 2, that would then be $600 because we would have taken $600 in depreciation. Yes.
Well, so basically, I just answered my own question, but for this, we basically take the year that it's good for and divide it by the total amount, right?
In this case, we divide it by the total amount. Some,
Okay.
as we see, some will have what's called a residual value or a salvage
You
value.
break it
So,
up.
okay, so remember, depreciation in accounting is allocating the assets cost over time. Don't ever depreciate land. Land can't be depreciated. Now we're going to talk about 3 methods of depreciating assets. We're going to use the straight line, the declining balance, and the activity-based. We're going to talk about these 3 methods. Straight line. You take the price, the cost of a truck, and we figure out what is the truck going to be valued at once it's all used up. In this case, they say at the end of its life, it's still going to have a value of $5,000 just for the scrap metal. So to depreciate using straight line, we take the cost of the truck minus the residual value we're estimating, and we come up with $35,000. And under straight line, if this truck is going to last us for 5 years, we take 35,000 divided by 5 years, and we get 7,000 each year. So the way we will show depreciation using the straight line method is after the first year, we take 7,000 or 20% of the depreciable cost, since it's over 5 years. At the end of the first year, our book value is sitting at 33,000. For the second year, we will take depreciation of 7,000. And at the end of the second year, our book value is 26,000. We will continue to decrease until we hit the residual value. We won't depreciate it below that residual value. Now, in a perfect world, we're saying the company, an asset is started on January 1st. But in the real world, it very seldom happens that way. So what if the delivery truck was purchased?
You're going in and out.
Okay, can you hear me now?
Yeah, it cuts you in and out.
Okay, I'm sorry. I moved my computer. I think that's why I did it. Sorry. So in this case, the delivery truck was purchased during the year, March 1st. I'm going to sit it back down so I don't have any problems. So the delivery truck was purchased on March 1st, and it was used for 5 years. Remember, 7,000 a year if the truck is utilized for the entire full year. But in this case, it started March 1st. So when it starts during the year, we only depreciate for the portion of the year that it began. So on March 1st, that means 10 months of the year, we're going to take depreciation because January and February, the truck wasn't around. So for the first year, we'll take $7,000 times 10/12 or 5/6 of the year because we didn't have it the whole year. Then in years 2 through 5, we'll take the 7,000 a year. And then remember in year 6, we'll take the remaining 2 months we didn't take in that first year. So just know when assets are purchased during the year, we have to take that into account. And in year 1, and then the last year of the depreciation, it will be prorated. Okay. Either way, we're taking the same amount of depreciation. We just have to prorate it. So guys, I want you to look at this one. How much depreciation should be recorded in the first year for a delivery truck purchased on April 1st with a cost of $30,000, an expected life of 5 years, and an estimated residual value of $5,000, assuming the straight line method. What do you guys think?
Is it A, 5,000?
Oops, sorry.
Oh.
The way we're gonna, the annual depreciation, you're right, would be 5,000, but since this one was purchased on April 1st, we've only got 9 months out of 12 months for the first year. Okay?
Oh,
So
okay. Yep.
5,000 times 9/12 since we bought it in April. So we would take 9 months out of 12 months and we would get $3,750. Okay. So what happens after year 3? They've been depreciating this truck, but they realize, wait a minute, we think we need to change something here. We're going to have 4 more years of use of this truck for a total of 7 years, rather than what they thought would be just 5. And then in addition, they say, we don't think the residual value is going to be 5 anymore. We think the residual value is going to be 3. What we do is once we make that determination, we don't go back and change anything we've done. We just move forward and change it. So at the end of year 3, this truck is now, the book value is $19,000. We subtract the new residual value of 3 to come up with the depreciable cost of $16,000. If we divide that by 4 more years of use, we'll depreciate year 4, 5, 6, and 7 at $4,000 a year. Okay? Any questions on that, guys? Let's do a problem similar
Say,
to
do you
this.
got another example so we can try?
Yep, that's what I'm going to do. Let's find one. Let me go. Okay. This is the one we're going to work on. Number 5. You guys have your computer. Go to number 5. The university car wash purchased a new soap dispensing equipment that cost $270,000, including installation. The company estimates that the equipment will have a residual value of $24,000. University car wash also estimates it will use the machine for 6 years or about 12,000 hours. So this is straight line. What I want you to do is figure out in years 1 through 6, the depreciation expense, the accumulated depreciation, and your book value. So I'm going to give you a couple minutes here and I will be right back. Okay? I'm going to just put it, I'm going to put the problem for this is our book value is going to be the 270 minus our 41,000 of depreciation, right? Which is going to be 229,000 here. The next time depreciation's 41,000, our accumulated is 82. Our book value at the end of year 2 is 188,000. Depreciation stays the same. Our new book value is 147. This will be 123. This should be 164. This should be 106. $205.
So in the accumulated depreciation, are you adding 41,000 each year to the number
Exactly.
before?
That is the
Okay.
accumulated depreciation we've taken over its life.
Okay. Makes sense.
Let's see what I'm doing here. Times 6, 246 here. $24,000. Is that right? Is that right?
Yeah.
Okay. Any questions on how we do the straight line method? Okay, let's go back to our PowerPoint and look at the next one. So this next one is double declining. Now, guys, a lot of people can have troubles with this, but let me just say it this way. Don't think of straight line and try to do this the way we do straight line, because it's not going to work. Okay, think of it as a different scenario altogether. When we do double declining, we literally double the straight line rate. So when in the previous example, we will depreciate something over 4 years, or in this case, over 5 years, because we were going to take it over 5 years. What we do with double declining is straight line would be 20, but under double declining, we double it. So we take it by 40%. We do not take into account at this time the residual value. We take the cost of the asset times the double declining amount, in this case, 40%. And our depreciation expense is 40,000 times 40% or 16,000. Our accumulated depreciation is 16,000. Our book value after year 1 is 40,000 minus 16,000 accumulated depreciation, or 24,000. Then for year 2, guys, this is important. You don't take the 40,000, you take the new book value after year 1, the 24,000 times 40% gives us 9,600. That 9,600 gets added to the accumulated depreciation. So at the end of year 2, our accumulated depreciation is 25,600. Our book value at the end of year 2 is now 14,400. For year 3's depreciation, we take the book value at the end of year 2 times 40% to give us our depreciation in year 3. Then that gets added to our accumulated to come up with our book value at the end of year 3. We then take 8640 times 40% to get our depreciation at the end of year 4. We continue to do the thing. Here's the catch. If our residual value is 5,000, we cannot go below our residual value. So if we take 5184 times 40%, we would go below 5,000. We can't. So we take in year 5 the depreciation expense to just hit the residual value of $5,000. So in this scenario, remember, it's totally different from straight line. Don't think it is, don't try to make it like that. You take the book value times the double rate. So let's look at this problem here and we'll do it together. This was number 5, doing the depreciation this way. Let's go and do another double declining. Here we go. University Car Wash purchased new soap dispensing equipment that cost $270,000, including installation. The company estimates the equipment will have a residual value of $24,000 at the end. We don't want this number to go below $24,000. They figure they're going to use the machine for 6 years. So 1 divided by 6 would be, we would have taken 16.66% each year if we were doing the straight line method. But doing double declining balance, we multiply that times 2, which means we take 33.33% each year. So if we take our 270,000 cost times 33.33%, that means we take 89,991 in year 1. 270,000 minus 89,991 gives us a book value at the end of year 1 of 180,009. Then we're going to take 180,009 times 0.3333%. So in year 2, we would get 59,997 in depreciation. 59,997 plus our 89,991 means our accumulated depreciation at the end of year 2 is 149,988. Subtract that from our 270,000 means our book value at the end of year 2 is 120,012. Take our 120,012 times 0.3333 to get our depreciation of 40,000. Right? 149,988 plus 40 would be 189,988. Our new book value is 80,012. Then we should have, I don't think I'm doing something right here. 270 minus 0.3333, 89,991. Then so you should have 80,000. Oh, see, I'm not, this isn't, we're just doing the first 4 years. I think that's the problem. We're not doing them all. So 80,012 times 0.3333 would be 26,668. 26,668. Add that to our accumulated depreciation. Should be 216,666. Subtract that from our cost. You should have a book value at the end of year 4 of 53,344. Let's just see. Something wrong. No. Oh, we can keep going. Sorry, I didn't see the other 2 years. There we go. So if we take 53,334 times 0.3333%, we get 17,780. We add our 17,780 to our accumulated depreciation to get our 234,446. We have a new book value, 35,554. Next, 35,554 times 0.3333% would be 11,850. That would bring this to 246, 296. But what can we not go over? 24,000. If I put this in here, guys, I would be at 23,704. I can't do that. This has to stay at 24,000. So the only amount of depreciation I can take to get this figure is 11,554. Okay. So this number is 246, and this book value cannot go below 24,000. Let's just make sure I got it right. Does that make sense, guys? Just to understand, when you do double declining, you take the cost and you multiply it times the straight line rate times 2. Then that's your depreciation. In the first year, that will also be your accumulated depreciation. You take the cost of the asset minus your accumulated depreciation to come up with your book value. The reason you need to be aware of the residual value is you cannot depreciate below the residual value. But unlike straight line, we don't worry about the residual value when we initially calculate how we're going to depreciate. We just take the cost of the asset times the straight line rate times 2. And we have to become aware of the residual value towards the end of the life because we cannot depreciate below the residual value. So you see in year 6, I plugged in this figure. Okay? Does that make sense?
How'd you come up with that figure though, to put in the depreciation for year 6?
Did I? Good question. I saw this book value I first took the book value, 35,554 times 33.33%. And when I did that and then subtracted out, I was below 23,000. So I knew I couldn't be below 23 or below 24. So once I saw I was below 24, I put in my 24 and I subtracted the 35,554 from 24. And I knew that's all it could be. Does that make sense?
How do you find the straight line rates? I'm trying to like just, I can't figure it out.
It's so, guys, it's so cool. Yes, thank you for asking. You see here it says to prepare a depreciation schedule for 6 years, because it told me the asset was going to be used for 6 years. So what I do, I take 1, divide that by 6, I get 0.1667. That would be using the straight line method. To use double declining, I take this amount times 2. And I get 0.3333.
Thank you.
Does that make sense, guys? Yes, no?
Yes.
Okay. Just remember, don't think of double declining like straight line. Treat it different. Okay. Now, let's look at this one. How much depreciation should be recorded for the first year of a delivery truck with a cost of $30,000, an expected life of 6 years, and an estimated residual value of 6, assuming double declining balance? We know 6 years is 1.666. Double declining, you multiply that times 2 to 0.3333. For the first year, wouldn't you take that 30,000 times 0.3333 and get $10,000 for the first year? Make sense? Okay. This last method is similar to straight line. It's similar to the first method. You're going to take, instead of years, you're going to take some factors such as mileage. And we're going to take our depreciable cost, just like we do in straight line, the 40,000 minus 5,000 residual value. Divide that by the number of miles to come up with 35 cents a mile. So in year 1, if we drove 30,000 miles at 35 cents a mile, we're going to depreciate 10,500 as our depreciation expense. In year 2, if we drove 22,000 miles, we'll take 35 cents a mile and show our depreciation expense there of 7,700. Then we add that to our accumulated depreciation from the year before to give us our new book value. This is just like straight line, except in using years, you use miles. And each year you know the miles, and you know you cannot go below the residual value. So then you stop. Think of activity-based and straight line similar to one another. Think of double declining totally on its own. Ultimately, no matter which method you use, you're going to end up with the same amount of depreciation in the end. It's just that each method does it differently. Straight line takes a flat amount every year. Double declining starts really fast, takes a lot of depreciation and then slows down. And activity-based only takes depreciation based on the number of whatever the factors are, machine hours, in this case, miles. And so the number of miles used each year by a rate is how you determine the amount based on activity based. Most people in the United States use the straight line method. It's easy. Know that tax depreciation is different from book depreciation. For purposes of accounting, most people use straight line. But for tax purposes, most people use modified accelerated cost recovery system. So let's look at this one, guys. The donut stop acquired equipment for $19,000. The company uses straight line depreciation and estimates a residual value of $3,000 and a 4-year service life. At the end of the second year, the company estimates that the equipment will be used for 4 additional years, for a total service life of 6 years rather than 4. At the same time, the company also changed the estimated residual value to $1,200 from the original estimate of $3,000. Calculate how much the donut shop should record each year for depreciation in years 3 through 6. So we see the cost is $19,000. We're going to have a 4-year service life with $3,000 residual value. So initially, we were going to depreciate it over $16,000 divided by 4 years, or $4,000 each year. So in years 1 and 2, we took $4,000 each year for a total of $8,000 for the first 2 years. So at the end of year 2, we've got a book value of $11,000. The 19 minus the depreciation we've already taken of 8, sorry, to make 11. Then it says, hey, at the end of year 2, we changed our residual value to $1,200, and we think we're going to make it for 4 more years. So what are we going to do? We take the $11,000 minus the $1,200 residual value to come up with a depreciable cost of $9,800. Take that divided by 4 years, means we will take depreciation in years 3, 4, 5, and 6 for $2,450. Okay. Now, instead of calling it depreciation, with intangible assets, we call it amortization. It's still allocating the cost of intangibles. Allocating is called amortization for intangibles. And we usually have no residual value on intangibles, or we don't. In this example, Little King Sandwiches acquired franchise rights from University Hero for $800,000 for 20 years. So what we would do in year 1, we would debit our amortization expense for $40,000, which would be $800,000 divided by 20 years. And we would credit franchises. We don't credit, as in depreciation, we would credit an accumulated depreciation. We don't do that with amortization. We just actually credit the intangible asset. In addition, Little King purchases a patent for the meat slicing process for $72,000. The original legal life of the patent was 20 years, and there are 12 years remaining. But due to expected technological obsolescence, the company estimates that the useful life of the patent is only 8 more years. Little King uses straight line amortization for all intangible assets. What will we take now since we changed it? 72,000 divided by 8. Debit amortization expense of 9,000. Credit patents. of 9,000. Does that make sense? So know that patents, copyrights, franchises, and trademarks with finite lives we amortize. We will never amortize goodwill, or we'll never amortize trademarks with an indefinite life. Amortization is a process similar to depreciation, in which we allocate the cost of intangible assets over their estimated service lives. Intangible assets with an indefinite useful life, goodwill, and most trademarks are not amortized. Okay, let's take this one. Which of the following intangible assets would not be subject to amortization?
It would be I think trademark.
Trademarks with an indefinite life. Excellent. Okay, now we're going to look at asset disposition by either selling it, retiring it, or exchanging it. Really the only three ways to get rid of stuff. So selling is the most common. Retirement, usually not so much because you retire it because no one's interested in buying it. And exchanges also do happen. So in this case, we have an original truck at 40,000. The estimated residual value is at 5,000. And the estimated service life is for 5 years. We're going to assume straight line depreciation, and we're going to figure out scenarios. What if we sold the truck after 3 years for 22,000? What if we sold it after 3 years for 17,000? And what if we retired it after 3 years or exchanged it? So we've got these different scenarios we're going to look at. Okay, the first one is we sold it for 3 years after 22,000. Well, we've got to look and see how much depreciation did we take in the first 3 years. If we have a truck of 40, and then we have the residual value of 5, that's 35,000. 35,000 divided by, service life 5 years. By 5 years is 7,000 a year. So 7,000 times 3 years is 21,000. Therefore, our basis in the truck after year 3 would be the 40,000 minus the 21, or 19,000. So what I'm going to do, let's put this on an Excel so it makes sense, okay? So we're going to take an Excel, and we're going to show the cost is 40, the residual value is 5, okay? The depreciable cost is 35,000. 35,000 divided by 5 years would be 7,000 a year. The book value, whoops, sorry guys. The book value is going to be the 40,000 minus the 7,000 cost here. After after the third year, do you see how we know that the book value is 19,000? Okay. Now the question said we sold it for 22,000 after year 3. So you see what we've got here is the sale amount of 22,000. We've got the book value at the end of year 3 of 19. So we have a gain here of $3,000. Remember, when we sell an asset, we need to get rid of the equipment in its full, the accumulated depreciation, the cash we're receiving, and then we'll show the $3,000 gain here. Okay, next one. Let's say we sold it after 3 years for $17,000. You see here we have a loss. Our cash is 17. We get rid of the truck. We get rid of all the accumulated depreciation. And we show a loss here of 2,000. If we just retire it, which means we show no sale, we have a total loss now of 19,000. We have to zero out the entire equipment. We want to make sure we don't zero out the net cost of the equipment, the net basis. We have to take out the entire original cost. We have to take out the entire accumulated depreciation. We have to zero those out. And in this case, we would have a $19,000 loss. What do you guys think here? If an asset's sold at the end of the first year of use, which depreciation method would result in the highest amount of gain or the lowest amount of loss, assuming the asset is used fairly over its life? Be double declining, because the most amount of depreciation happens early on, which lowers its basis in the asset or book value in the asset. Now let's talk about what happens when we exchange assets. We traded in a new truck for our old truck and cash. So we obviously traded in the old truck. They gave us $23,000 for it. So we have to show the new equipment. We have to show the cash we paid. If our old equipment, the original cost was 40, we have to zero that out. Also zero out our accumulated depreciation. And then we show a gain. Remember, if we dispose of an asset for more than book value, we're going to record a gain. But if we dispose of it for less than book value, we're going to record a loss. Okay, I want you to look at this one second here. I'll be right back. I can't right now. Okay, sorry, guys. So on this case, do you see? It tells us the tractor had a cost of 42,000. It's sold, so we have to totally wipe out that tractor. We have to totally wipe out the depreciation. And we can see the depreciation. Well, I'll talk about that in a minute. We sold it for 21,600. We know we have that as cash. And we know we had a residual value of 3,000. The cost was 42. So the 42 minus the 3 is the 39,000. If we divide that by 5 years, we figure out how much we were depreciating a year, and we depreciated it for 3 years. So we know we had depreciation of 23,400. Okay. So in this scenario, we know our cash, we know the cost of the equipment, we zero out the accumulated depreciation, we have a gain of 3,000. Okay. Abbott Landscaping purchased a tractor at a cost of 42 and sold it 3 years later for 21,600. What if instead the tractor was sold for 13,600 instead of 21,600? Okay. You see here, instead of having a gain, we would have a loss of $5,000. The next bit has some ratios that I'm going to let you do on your own. Remember, in chapter 13, we'll be covering all these ratios. The last piece I want to talk to you about is what's called impairment on intangible assets. There is a two-step process you need to be aware of. There are times when an asset will possibly be lower than the book value. The actual value could be lower than book value. In dealing with this whole Russia-Ukraine thing, I believe it was Shell that came in, or it was British Petroleum that came in and said, we're going to have an impairment loss with pulling out of Russia. What does that mean? You look at future cash flows of an asset, and you look at the book value of an asset. If the future cash flows are less than the book value of an asset, the asset is impaired. That's how we determine if the asset is impaired. If the future cash flows are greater than the book value, you do nothing. If we see the asset is impaired, then we record a loss. And the loss is equal to the book value of the asset in excess of the fair value of the asset. So the step one allows you to see if the asset's impaired, that future cash flows are less than book value. If that's the case, then you record the loss by showing the difference in the book value minus the fair value of the asset. So estimated future cash flows generated for a long-term asset fall below its book value. Trademark has estimated future cash flows of 20,000, a book value of 50, and a fair value of 12. So we know the asset is impaired because the future cash flows are less than the book value. To record the loss, we take the difference. If the fair value is below the book value, we've got a loss. The 50 minus the 12 needs to be written off. So the 38,000 is shown as a loss, and we reduce the trademark down by 38,000 to come up with its new fair value of 12,000. Okay. An impairment loss is recorded when the book value exceeds the estimated future cash flows. Okay, so that's it for this chapter.